All right, welcome everyone. Today we're going to break down something that honestly has a huge impact on your financial life, interest rates. We'll get into what they are, who's in control, and most importantly, what it all means for your money. So let's just jump right in. What if I told you there's one single number, just one, that pretty much shapes your entire financial future? It has a say in the cost of your home, the money you earn on your savings, and yeah, even your job security. Well, that number is what economists call the price of money. Sounds a little weird, right? The price of money? But it's actually a super simple and powerful idea. Let's get into it. So what does that actually mean? Think of it like a two-sided coin. On one side, if you're borrowing money, say for a car or a house, the interest rate is the fee you pay. It's the cost of using that cash. But flip that coin over. If you're saving money, the interest rate is your reward. It's what the bank pays you for letting them hold on to your money. So you see, depending on whether you're a borrower or a saver, this price of money is either working for you or against you. It's really the engine that makes the whole world of borrowing and saving go round. Okay, so if this price of money is so important, who decides what it is? I mean, it doesn't just pop up out of nowhere, right? Turns out, there's a very powerful group of people pulling the levers behind the curtain. That power, well, it belongs to a country's central bank. In the US, that's the Federal Reserve. They set what's called the base rate, and you can think of that as the foundational, the master interest rate for the whole economy. From that one number, every other bank, from the huge global ones right down to your local credit union, they all take their cue. Now, this isn't some decision they make on a whim, in a smoke-filled room. It's a very careful, data-driven process. I like to think of them as a team of economic doctors. First, they gather all the vital signs of the economy, things like inflation, job numbers, how much people are spending. Then they get together and they assess the health of the economy. Is it running a fever? Is it getting sluggish? And based on that diagnosis, they vote on the right prescription: raise rates, lower them, or just hold steady. And then they announce it to the world. And here's where it gets really interesting. That one decision, it doesn't just affect the banks. Oh no. It kicks off this massive chain reaction, a huge ripple effect that spreads across the entire economy. Think of it like this. Raising interest rates is like gently tapping the brakes on a car that's going a little too fast. The central bank raises that base rate, and suddenly, borrowing gets more expensive for everyone. Mortgages, car loans, business loans, you name it. So what do people do? We spend less. And when we spend less, businesses see less demand. And when demand cools off, that pressure cooker of inflation starts to release some steam. The whole goal is to slow things down from a boil to a nice, steady simmer. Okay, so we've talked about the big picture, the whole economy. But what really matters is, what does all this mean for you, for your wallet, your bank account? Let's bring it right down to your bottom line. Yeah, at its core, it's kind of like a seesaw. When interest rates are high, that's fantastic news if you're a saver. You earn more on your cash, which is great, but it's a really tough time to be a borrower because loans are just so expensive. Now, when rates are low, that whole seesaw flips. It becomes super cheap to borrow money, but you'll get next to nothing on your savings. And this is where the rubber really meets the road for your personal finances. Think about it. Higher rates could mean your monthly mortgage payment is way bigger on a new loan. That credit card debt you're carrying, the interest on that starts to sting a lot more. But on the flip side, your savings account might actually start earning you some real money for a change. It even affects your stock portfolio and, believe it or not, can impact job security as companies decide whether to hire or hold back. Now, it's really important to remember that this whole thing, steering the economy with interest rates, it's not a perfect science, not even close. The people in charge are performing this incredibly delicate balancing act, and believe me, there are some major risks. For starters, there's a huge time lag. It can take a year, even 18 months, before a rate change really has its full effect on the economy. And that creates this massive risk of overshooting. Tapping the brakes too hard and accidentally causing a recession. And that's not even getting into the wild cards, things like global pandemics or wars that can just completely throw a wrench in all their careful plans. So this leaves us with a really important question, right? If the experts themselves are walking this tightrope, what are we supposed to do? Well, the key takeaway isn't about trying to predict their every move. The real power comes from just understanding how the game is played. Because when you know how these shifts work, you can build a financial plan that's resilient, one that's ready for whatever the economy throws at it. Thanks so much for joining me for this explainer.